Good afternoon, everybody, and welcome to the economic update for late October. It is October 26, 2014. And if you'll remember the last upload I did, it was called the Jade Apprentice, and how you can sort of know when a market is in trouble or when it's not. And it's not something market feel that you learn just by reading one book, 10 books, 100 books. It only takes time and exposure to the market. Because over the last 10 days after I did the upload, of course, we had a terrific drop in the market down to about 15,990 from 17,250. A pretty significant drop in a very short period of time. And people got scared witless. Now, if you remember, weeks ago, a month ago, I was talking about how the market behavior flashed a yellow signal for us that all was not well within the market. Although we could not know the huge drop that was coming up, the warning signs were there, and I took that opportunity every time, as you remember, that the market had a strong day or a strong week, I would sell more and more of my market positions in that. Okay, until finally when the big drop came, I really had nothing left in the way of market positions on the for the ride down. So, as I also mentioned in the last upload, bull markets do not fail on drops, they fail in rallies. Okay, and it's very true, and this was amply demonstrated by the terrific drop and recovery of the subsequent 6 or 7 trading days. If you guys remember when we topped out, then we had that crazy up and down action. We'd be up 200 points, down 200, up 180, down. You know, we were zigzagging, which showing something big is going on up there. And then we had the big drop. I knew at that point when the big drop bottomed out that the market would not be going straight down after that, okay? Because why? Because bull markets fail in the rally. And let's talk about what I mean here. And I hope you can see this today. We're using a little visual aid on the back of the pizza thing here. And as you'll see here, and I wonder how well you can see that pretty good. A market will start out here and it'll build a nice slow base and it'll start to rise, pull back. Not a lot of people are interested, and it goes moving on, and as it goes higher and higher, more and more people start getting into it until sadly when you reach the very peak up here, you're inundated with lots of new people buying and buying and buying. Why? Because a market always goes up, right? They're thinking, gee, this is a one-way ticket. And sadly, when it gets to the top, you know, we have they're buying heavily all through here in the big spike. Why? Because the market is making news in the newspaper and all that. It's reported Dow Jones has tremendous day, up 280 points, 300 points. It catches people's attention. And then suddenly we get that action up here where we're zigzagging back and forth and we're not making any progress. And we're starting to act weird. You know, we're having days that are as big on the downside as upside. Okay, because for the past year and a half, the market just went up, up, up without any real corrections here. So what happens after a piece is you get that first terrific drop that we had. Boom! Almost straight down. And you can see that coming down there. The first 1,500 points. And what does it do? It scares the living hell out of people, okay? Because they've not been conditioned for a drop. All they can think of is markets rise, rise, rise. And when they're not rising, they're pulling back in little gentle, slow pullbacks. This was a terrific smash of about 1,100, 1,200, 1,300 points here, okay? It scared a lot of people. Percentage-wise, it wasn't great, but headline-wise, it was big. You know, Ebola and all that kind of stuff was coming in. Now, you know, declining oil prices. Now, the reality is, what's going to happen if you're a kind of a newbie trader, you get down this panic, man, you're down another day, you're down 487 points intraday. you just call your broker and you say, look, get me the hell out of the market. I don't care what you do, just sell it. I don't care. So what happens, everybody sells there, and then the market starts to run up with this terrific rally that we've had the last 7 days. Okay, and you get something like that. You get a huge drop, and then you get a rally. Now the key is, a smart trader will think, you know, the best, if he hasn't sold yet, a smart trader will, like I talked about, we knew that a big rally was going to come because bull markets don't fail on a drop, they fail on a recovery attempt. In other words, every bull market will attempt to try to make a new high, and that's what happened here after that big smash of 3 weeks ago. This is the point last week where, you know, if I'm going to put in a position at this point here, up here, I'm not sure which way the market's going right now. Remember, we're on a yellow caution. We're not red, we're not green, we're on a yellow caution, which means this may end up being just a big correction and we move on to ever higher prices. Entirely possible. Or else this recovery rally that's taken place over the last 6 or 7 trading sessions is going to run out of steam, and it's going to bring in a whole new round of selling. And what's going to happen is it starts to go down the other side here, down the other side, and away goes the market to a big bear market, okay? So this is the point late Thursday when I thought this market's probably rallied enough in here. I'm going to take a chance and sell short or establish some positions that should profit if the market goes down. Now, to a lot of people, you think, you can make money when a market goes down. Yes, you can. It's called selling short, but even better these days, we have instruments called exchange-traded funds on the New York Stock Exchange that you can buy them to do what you want them to do. In other words, if you think the market's going to drop, you can buy a stock called the ticker symbol, the Dow Jones Short, the Dow Jones Industrial Average Short Index, ticker symbol DOG, and as the market declines, it makes money. Okay, it's the opposite of most things in the market that only make money when it goes up. So I took the chance and I sold that market here. Now, the reason I did that, because look at this, if this rally continues and the market makes a new all-time high, I can close out my position up here past the old-time high with very little loss. But imagine if you were down here after that terrific smash and you thought, oh, the market's going to go much lower. So you bought your short position expecting the market to go lower, and what happens? You have this big rally that whipsaws you. You're losing money on the downside because you didn't sell your positions into strength, and now you're losing money on the upside because you've shorted a market that's rallying, okay, and you don't know what to do except hold on to dear life. So instead, this would define your risk zone here. When you sell here, look at where I am selling, way up here. The difference is phenomenal in terms of potential profit for these 2 points. Now, what do I mean when all is said and done? If this market turns lower again, which it may very well, then I stand to make a lot of money as this bear market unfolds. I took a position up here with very little risk on the upside. Now, why do I say very little risk? Because if the market makes a new all-time high, it's only going to be about 300-400 points from where we are right now, and that will define my risk point. If it makes a new high, hey, I'll be happy. I'll turn my positions and I'll go along for the ride. On any renewed weakness, I'll hold to my theory that only rising interest rates can crush a stock market. If this is the one time that law doesn't hold true, then I have a whole lot of profit ahead that other people don't have, okay? This is why you have to establish trading positions in markets so that you can minimize your loss if you're wrong. If I sell the day after the market's had this 10 days of a terrific drop, you know, the chances are I might be selling into the beginning of a rally, and then I just have to hold on for dear life as I'm swept back up and the market goes back up, and what I sold down here is now much more valuable than where I sold it. That's a really crappy feeling when it comes to trading. So the difference is you want to be selling and buying at the right time. When you buy, if you think that you're in a bull market, you want to buy in periods of weakness. You want to buy down here in this kind of smash that occurred. And if you're bearish, you want to sell after it's already had a terrific rally up here, because your potential risk area here is so small. In other words, instead of losing 1,500 plus points here on the wrong side of the market, you're only losing 300 or 400. You've minimized your risk by 60, 70%. It's great. It's the way professionals trade on Wall Street. If they think it's a bull market, they buy on weakness. If they think it's a bear market or a market that's gone down, they sell into strength. They sell into these big rallies that get the headlines, okay? This is just a quick sketch overview because I think this market's unfolding exactly as I thought it would and exactly as I told you that it would. We had that long sustained rally that we've been bullish as long as I've been putting these uploads together. We hit that weird action up there, and my trading, the Jade Apprentice trading, came in and said, something's wrong, this is not Jade, this is fake. Something started happening up here to tell me that the picture's changed and something weird is starting to occur here. It's time to take the chance to sell into any kind of strength and move aside. And then of course, after I sold all of my positions up there, we had that huge drop down that shook the hell out of people. And then when everybody else was suddenly turning bearish, you know, and throwing in the towel, what does the market do? It rallies again, getting people caught the wrong way again. It's called being whipsawed back and forth because their emotions take over. So now when they've gone up with this big rally we had for the last 6 or 7 trading days, this big 700, 800 point rally, everybody's all bullish again. They're all excited. We're all underway. So what do? They're buying heavily up there. And what happens? You set yourself up for another terrific smash of what could be a early stage bear market, and you could be trapped in your position for years. And you don't think you could lose a lot of money? In the 1929 to 1932 bear market, stocks lost 90% of their value, okay? You don't want to be caught on the wrong side. So what does it all come down to? What's the bottom line? This. It's going to be a very interesting next week or two in the market. And the beauty is the market's going to tip its hand very soon, all right? It's either going to go rolling on to a new high up here and put all this nonsense behind it, or we're in the very early stages of what could be a very terrific drop in the market ahead. Stay tuned, okay guys? This is going to be exciting. I'm telling you now, I sold the market on Thursday in the expectation that this week sometime we may turn down again. But if I'm wrong, I will be the first one to close out that position, reverse, and get back with the bull trend again. That's what traders do. Do not stay wedded to a position if things are changing. Okay, this was a little more detailed than our usual economic chooch. I'm still not a believer. You know, underneath of all this, the economy's got serious problems. I mean, the reason that oil prices are dropping is that demand is dropping along with a huge increase in supply with fracking and things like that. Now we have oil that'll probably break through $80 a barrel, a price we haven't seen for years, okay? That's why your prices at the pump are cheaper and all that. But it's not necessarily a good thing because worldwide demand is dropping here, okay? There's too much oil in the world and there's not enough demand to keep prices up. The other secret thing that's going on is interest rates are dropping, okay? And why are they dropping? Money, because money is a commodity like anything else in the world. If the demand for money is great, the price or the interest rate charge increases because a lot of people are willing to pay to get the money to borrow. But if there's no demand there, interest rates drop because nobody's coming up to the borrowing window. So what do they have to do? They have to put money on sale. And the way they do that is interest rates drop. Now, the reason interest rates are down is there ain't a hell of a lot going on in the economy, okay? The Federal Reserve is scared because if the economy goes down hard again, which I expect it will, because this was really a crappy recovery, the Fed has no more tools to fight deflation, and we relive the whole 1932 experience again, the whole Japanese experience, the whole thing all over again. It's going to be very interesting to see. Protect your money, use your brain, choose your positions wisely, understand why things happen. Don't be one of the people that stand there and say, wow, it's really a beautiful thing that the interest rates are dropping. They're panicking at the Fed. They hate that. They want to see the demand for money rise. They want to see interest rates tick higher. But instead they go down, down, down. It's almost like the mirror image of what's going on with stocks here. Interest rates just drop, okay? Because true demand for money is kind of weak. Now, you've also seen this week amidst all the hubbub of Apple, and Apple's a great company, but meanwhile, IBM got smashed, okay? Huge air pockets of people dumping shares of IBM because their business stinks. And also Coca-Cola got smashed up pretty good too because their business stinks. McDonald's business, there's real world companies that are having real struggles, increasing sales and increasing profitability, okay? It's been a long chooch today. Watch it a couple times, absorb it, get the ideas that are here, okay? You too can make it in the market if you just understand the way the system works. These are just my opinions. All trading decisions, investment decisions are done by you in consultation with an investment advisor. Okay, everything we talk about is theory here. We don't talk about individual positions that would be appropriate for your portfolio. Okay, thanks for watching and stay tuned for the next economic update. I have a feeling it's probably going to be a doozy. Thanks for watching.